Now to developing news out of Washington. As expected, the Federal Reserve raised the interest rates by 3/4 of a point for the first time since 1994. It typically raises rates 1/4 of a point. The move is meant to slow down inflation.
The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down. The current picture is plain to see. The labor market is extremely tight, and inflation is much too high.
Powell indicated another large rate hike isn't out of the question. The big question, though, is what does this mean for you? Joining us now to talk more about this is Tim Fitzwilliams, a financial planner with Fitzwilliams Financial. Tim, thanks so much for joining us tonight.
Thank you, Len. I appreciate you having me.
Of course.
So, pleasure.
Why did the Fed make this decision, and what do they hope to do?
Well, it's a complicated answer, but to keep it very simple, it's because we printed a lot of money. We printed a lot of money, and they have to keep things into control. And so to raise interest rates, they're hoping it will stop some of the demand. So therefore, they have more control, and we're not in what we call a hot economy, right? And where the gas prices are through the roof, as everybody knows.
Right. So when will we kind of see this take effect? When will we feel the impacts of it?
Great question. Unfortunately, it doesn't happen overnight. Even though we had a major hike today, you're probably not going to see effects for 6 to 9 months. And since it's already slated for there to be more hikes on into next year, that means we probably won't really see anything until like the end of next year.
So how is this going to affect savings for people?
Sure, it's going to affect savings in a real way, and it's also going to affect your ability to buy things because debt is going to become more expensive. So buying a car, a boat, a home, something like that is going to cost you much more now to buy that than it did, say, last year. On the flip side, as things kind of iron out, we will see a better savings rate. So that's a good thing.
What kind of advice do you have for people? Like, should they wait to buy a house or a car? Should they try and spend less? What would you tell people to do?
Well, I do think a lot of people are going to see their budget start to get smaller and smaller as their purchasing power is getting weaker. So I think now is the time more than ever. You need to have a financial partner in your pocket, someone that you can trust to help you navigate these turbulent times, to really go over your financial plan, not just to invest for you, but actually have a financial plan. Go through the details, go through your budget. If you do need to buy a house now, then you have to buy a house, but let's plan it out so that there's not a loss of lifestyle, that everything works out okay.
When we look toward, we look at gas prices, we look at inflation and the prices of everything, when do you think it might kind of calm down a little bit? Is that 6 to 9 month time frame?
Yes, and then that's kind of the start. So I think we'll start to see things start to level out end of next year.
Wow, that feels like a long time away.
It can be, right. But they definitely are concerned. I mean, we printed an awful lot of money. We did a lot of things, according to economics, that we shouldn't do. And one of the biggest tools that the Fed has is the power to change the interest rate. And unfortunately, the Fed doesn't care about your 401k or your savings. What they care about is the purchasing power of the United States of America. So it's very important that the average consumer understands why we're here. So what they need to do to prepare themselves, because this could be a long ride. It might not just be a short thing, as a lot of people hope that it would be.
Right. Well, everyone is hoping for the best, but
right.
It could be, like you said, a long ride. Tim, thank you so much for coming in
Absolutely.
here and breaking it down and explaining for us. We appreciate it.
Thank you for having me. Appreciate it.
Of course.